Here's something that sounds completely backwards. The dividend stocks with the highest yields are often the worst investments you can make. I know that sounds crazy. If you're building an income portfolio, wouldn't you want the highest income possible? That's exactly what I thought when I started dividend investing. And it's the single mistake that cost me more money than anything else I've done in the market. Look, I get the appeal. You see a stock paying 8% dividends while the market average is around 2%. And it feels like free money. You run the math in your head, put in $100,000, collect $8,000 per year, and you're living the dream. But here's what nobody tells you when you're starting out. Yield chasing is a trap, and the data proves it. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. Over the past 50 years, the stocks with the highest dividend yields actually underperform the broader market. We're talking about a 1% annual underperformance, which might not sound like much until you realize that over 30 years, that difference turns $100,000 into $1.3 million instead of $1.7 million. You literally left $400,000 on the table by chasing yield. So if high yields don't work, what does? That's exactly what we're covering today. I'm going to walk you through the simple dividend portfolio I'd build if I were starting from scratch in 2026, backed by decades of institutional research and real historical data. No hype, no guarantees, just what has actually worked over time. Now, before we dive in, let me be clear about something. Nothing I'm sharing here is financial advice. I'm not telling you what to do with your money. I'm simply breaking down what the research shows and how I think about dividend investing based on that data. Your situation is different from mine, and you should make your own decisions or work with a qualified advisor. All right, let's get into it. The first thing you need to understand is why dividends matter in the first place. And I'm not talking about the emotional appeal of getting quarterly checks. I'm talking about the mathematical reality of long-term returns. From 1940 to 2024, dividend income contributed about 34% of the total returns in the S&P 500. But here's where it gets interesting. When you look at the full picture including reinvestment, dividends and the compounding from reinvesting them accounted for 85% of total returns over certain long periods. Let me say that again, 85%. That means if you ignore dividends completely, you missed out on the majority of the market's long-term wealth creation. Here's a simple way to understand this. If you invested $1,000 in the S&P 500 back in 1930 and just held it without reinvesting dividends, you'd have about $258,000 by 2021. Pretty good, right? But if you reinvested those dividends, that same $1,000 grew to roughly $7 million. That's 27 times more wealth, just from reinvesting the dividends you received along the way. This is the power most people completely overlook. They think dividends are just nice supplemental income. But historically, reinvested dividends have been the primary engine of compound growth in equity markets. The stock price appreciation is actually the smaller part of the equation when you zoom out over decades. Now, here's where dividend investing gets even more interesting. During market crashes. Because while your portfolio value might be dropping on paper, your dividend income typically stays remarkably stable. And this is where dividend investing shows its real strength. During the 2007 to 2009 financial crisis, the S&P 500 dropped 55%. That's a gut-wrenching decline. But here's what happened to dividends during that same period. On average, S&P 500 dividends only fell about 2%. Think about that ratio. Stock prices down 55%. Income down 2%. That's a 15-to-1 difference in stability. And if you look at individual quality dividend payers, the resilience was even more dramatic. Coca-Cola was down 31% versus the market's 55%. Johnson & Johnson down 27%. These companies kept paying and even growing their dividends while everything around them was collapsing. That steady income during a crisis isn't just psychologically comforting. It's the financial cushion that lets you hold through downturns instead of panic selling at the bottom.
This pattern shows up in the academic research too. Studies have found that dividend-paying stocks outperform non-dividend payers by about 1% to 2% per month during declining markets. That's not a small edge. Over a full bear market, that difference compounds into serious outperformance. But here's the crucial part most YouTube videos skip right over. Not all dividend stocks provide this stability. Only the ones with sustainable dividends. And that brings us to the most important distinction in dividend investing: dividend growth versus high yield. Let me give you a real comparison that shows why this matters. Back in 2008, you could have bought Visa with a 0.2% dividend yield, or Verizon with a 5.6% yield. Most income investors would have picked Verizon without thinking twice. 28 times more income, right? But by 2023, here's what actually happened. Visa's dividend had grown so much that if you bought in 2008, you were now earning a 12% yield on your original investment. Verizon? After 15 years, your yield on cost was 7.8%. The low-yield stock actually delivered more income long-term because its dividend grew consistently, while the high-yield stock's dividend growth was minimal. This is the pattern you see over and over in the data. Dividend growth beats high yield almost every single time when you measure over 10, 20, or 30 years. And the reason is simple. High yields usually exist for a reason, and that reason is usually bad. Here's what the research shows. About 60% of all dividend cuts since 2007 came from companies with the highest payout ratios. What's a payout ratio? It's just dividends divided by earnings. If a company earns $1 and pays 90 cents as a dividend, that's a 90% payout ratio, and that's a warning sign. Companies in the highest yield category averaged 75% payout ratios, while more moderate yielding companies averaged just 40%. That 35 percentage point difference is the difference between sustainable and unsustainable. When you're paying out 75% of your earnings as dividends, you have no buffer. One bad quarter, and the dividend is at risk. One recession, and the dividend gets cut. And when dividend cuts happen, they're brutal. The research shows that when companies combine high yields with high payout ratios, the average dividend cut is 36%. You go from collecting what you thought was safe income to watching a third of it disappear overnight. Then the stock price typically drops another 20% to 30% because the market reprices it without the dividend support. So if high yield doesn't work, what does? The answer is building a simple portfolio around 3 core principles: dividend safety, dividend growth, and just enough diversification to sleep well at night. Here's how I'd structure it if I were starting from scratch in 2026. 3 layers, that's it. Not 50 stocks, not 10 ETFs, just 3 clear layers with specific purposes. Layer 1 is your dividend foundation. These are the boring, stable companies that have raised dividends for 25 years or more. We're talking about dividend aristocrats. Companies like Coca-Cola, Procter & Gamble, Johnson & Johnson. They're not going to triple overnight, but they've survived multiple recessions, market crashes, and decades of economic cycles, while increasing their dividends every single year. This layer gives you stability. The average yield here is around 2.5% to 3%, which sounds low until you realize these companies grow their dividends at 5% to 7% annually. In 10 years, your income from this layer doubles. In 20 years, it quadruples. And they do it with payout ratios between 40% and 60%, which means they have room to maintain dividends even during tough times. Layer 2 is your dividend growth engine. These are slightly younger companies with shorter dividend histories, maybe 10 to 20 years instead of 25 plus, but they're growing faster. Companies like Microsoft, Visa, or specific sector leaders that are still in growth mode. Starting yields might be lower, maybe 1.5% to 2.5%, but dividend growth rates can hit 8% to 12% annually.
This layer is your inflation protection, because here's what people don't realize about retirement income. If you retire with $40,000 per year in dividend income and there's no growth, that $40,000 loses 26% of its purchasing power over 10 years at just 3% inflation. But if your dividends grow at 5% per year, your income actually increases to $65,000,
which is a 46% increase in real purchasing power. That's the difference between struggling in your 70s and living comfortably. Layer 3 is optional, but helpful for some people. It's an income stabilizer. This might be a utility company, or a real estate investment trust, or an energy stock that pays a bit more current income. But, and this is critical, you're still checking payout ratios and sustainability. You're not chasing 8% yields. You're looking for 3.5% to 4.5% yields, with reasonable payout ratios below 70%. The whole portfolio might have 5 to 7 total positions. That's enough diversification to avoid single stock risk, but simple enough that you actually understand what you own. Research shows that once you get past about 12 to 18 stocks, additional diversification adds almost nothing to risk reduction. You're just making your life more complicated for no benefit. Let me show you what this actually looks like with real numbers, using conservative assumptions. Let's say you invest $100,000 into this type of portfolio. Your average starting yield is around 2.8%. That's $2,800 in year one income. Not exciting, I know. But here's where it gets interesting. If these companies grow dividends at 5% to 6% annually, which is below the historical average for dividend aristocrats, your income grows to $4,570 by year 10. By year 20, you're collecting $7,490 per year. By year 30, it's $12,230. And remember, this is without counting any stock price appreciation. This is just the income stream growing. Now add in reinvestment. If you reinvest those dividends instead of spending them, and your total return averages 6% per year, that $100,000 grows to roughly $179,000 in 10 years, $321,000 in 20 years, and $574,000 in 30 years. This is using conservative assumptions, below what dividend aristocrats have historically delivered. And before anyone asks, no, this is not a guarantee. This is what the historical data suggests is reasonable based on past performance. Future results will be different. Markets don't move in straight lines. But this is the framework that has worked through multiple decades of different market environments. You want to see the ultimate example of this strategy in action. Look at Warren Buffett's Coca-Cola position. He bought it between 1988 and 1994 for about $1.3 billion. In 1994, he was collecting $75 million in dividends. Nice, but not life-changing for Berkshire Hathaway. Fast forward to 2022. Those dividends had grown to $704 million per year. That's a 9.4 times increase. His yield on cost, meaning the dividend relative to what he originally paid, is now over 62%. He's earning 62 cents in annual dividends for every dollar he invested 30 years ago. And the cumulative dividends over that time, $11.7 billion on a $1.3 billion investment. That's 9 times his money, back just in dividends, before counting the stock price increase. Or look at American Express. Buffett invested $1.3 billion in 1995 with a starting yield of just 3.2%. Most income investors would have called that pathetic. By 2022, those dividends reached $302 million per year, a 7.4 times increase. His current yield on cost is 23%. That low-yield investment turned into a machine generating 23% annual cash returns on his original capital. This is what patience looks like. This is what focusing on dividend growth instead of dividend yield delivers over time. Buffett wasn't chasing yield. He was buying quality businesses with sustainable payout ratios and long-term growth potential. Then he did nothing except collect the checks. Now let me give you the 3 biggest mistakes to avoid, because knowing what works is only half the battle. You also need to know what destroys returns. Mistake number 1. We've already covered it. Yield chasing. If a dividend yield looks too good to be true, it probably is. Anything above 6% in today's market should make you immediately check the payout ratio, the company's debt levels, and recent earnings trends. High yields come from either falling stock prices, unsustainable payouts, or both.
Mistake number 2 is ignoring payout ratios. You can find this number in about 30 seconds on any financial website. Just look for payout ratio. If it's above 80%, walk away. If it's above 90%, run. The company has no margin for error. The first time earnings dip, the dividend is getting cut. Safe payout ratios are between 40% and 65% for stable companies, and even lower for cyclical businesses. Mistake number 3 is overcomplicating your portfolio. The research on this is fascinating. Simple portfolios consistently outperform complex ones, not because simplicity is magically better, but because investors actually stick with simple strategies. When you own 30 dividend stocks, you can't keep track of all of them. You don't notice when payout ratios creep up or when earnings start declining. You end up with a portfolio that drifts into danger without you realizing it. A portfolio of 5 to 7 quality dividend growers that you review once per quarter will beat a portfolio of 30 stocks you barely understand. Plus, the behavioral aspect is huge. When you deeply understand your 5 holdings, you don't panic sell during market drops. You trust the process because you've done the research. So here's what this all comes down to. Dividend investing isn't about finding the highest yield. It's not about getting rich quick. It's about building a system that generates increasing income over decades, while you focus on living your life. The research is clear. Quality dividend growers with sustainable payout ratios, consistent free cash flow, and moderate starting yields have historically delivered superior returns to both high-yield strategies and non-dividend paying growth stocks over long periods. They do it with less volatility, more income stability, and better risk-adjusted returns. Is this strategy exciting? No. Will it make you rich overnight? Absolutely not. But if you're thinking in decades instead of months, if you understand that real wealth compounds slowly and steadily, if you can ignore the noise and stick with quality businesses that pay you to own them, this approach has proven itself through a century of market data. The simple dividend portfolio for 2026 isn't complicated. It's 2 to 3 dividend aristocrats for stability, 2 to 3 dividend growth stocks for inflation protection, and maybe 1 or 2 higher yielding positions for income balance. Keep payout ratios between 40% and 65%. Make sure free cash flow covers dividends. Reinvest everything. Review quarterly. Rebalance annually. That's it. The math works. The history supports it. The question is whether you have the patience to let it work for you. Because that's really what separates successful dividend investors from everyone else. Not intelligence, not timing, not luck. Just the ability to buy quality, reinvest the dividends, and wait. If you found this breakdown helpful, do me a favor and hit the like button. It helps more people find content like this instead of the usual hype. Drop a comment if you're building a dividend portfolio or have questions about the strategy. And if you want more data-driven investing content, subscribe so you don't miss the next one. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.